Hi, we're continuing with Chapter 18 and we're going to focus on some profitability indicators today. Firstly, we're going to look at return on owner's investment, also known as ROI. It assesses profitability from an investor's point of view, where we compare net profit to average owner's equity invested. It measures how effectively capital is used to earn a net profit. So we can see the formula here. It's net profit over average owner's equity times 100. Looking back at Google's, the example of Google, over 2013 and 2014, we can see their equity, and it has increased over the 2 years. We looked at Google's net profit from lesson 1, and here it is again, income before tax. It did increase between 2013 and 2014. We're going to compare it with the total equity over the 2 years. Looking at the average, so we've got 2012 here as well. So in 2013, using the formula, we calculate the average of owner's equity first. Following through with the formula, you can see that Google is earning at almost 20 cents net profit for every $1 of equity invested. Looking at 2014, we're using the average of the equity over 2013 and 2014 and the greater net profit. We can see that Google is earning 18 cents net profit for every $1 equity invested. So what does this mean? So the Google's ROI has actually worsened over the years, where it's decreased from 20% to 18.06% respectively, despite there was an increase in overall net profit. Now this is the interesting part. Net profit had increased over the 2 years, but the increase in average owner's equity was greater. Therefore, overall, return on owner's investment fell. So therefore, Google is not using its equities effectively to earn a net profit over the period. Just looking back at this page again, a greater net profit, but owner's equity increased even more. That means Google's putting in a lot more capital into the business to invest, but the increase in the net profit was not as great as they hoped, and overall, as a percentage, ROI has fell. Okay, now looking at return on assets, this one measures profitability from a manager's point of view. So we compare net profit to average assets. It measures how effectively assets are used to earn a net profit. The formula is similar to ROI, but it's net profit over average assets instead of owner's equity times 100. Now looking at Google's assets over the 2 years, we can see also they've increased between 2013 and 2014. Looking at Google's ROA, similar to before, in 2013 we follow through with the formula. We take the average assets between 2012 and 2013. We can see that Google is earning 15.5 cents net profit for every $1 of assets invested. Over in 2014, we take the average of the next 2 years, and we can see that Google is earning 14 cents net profit for every $1 assets invested. And what does this mean? It means that Google's ROA has worsened also over the years from 2013 to 2014, where it decreased from 15.5% to 14.3% respectively. Again, despite an increase in overall net profit, the increase in average assets was proportionally greater. So ROA, so this is a typo, it's meant to be ROA, ROA has also fallen. Google is not using its assets effectively to earn a net profit over the period. So looking at the figures again, a greater net profit, but assets has increased proportionately more. So as a percentage, the use of assets has not been as effective. Now let's look at the debt ratio. The debt ratio measures the percentage of a firm's assets that's financed by liabilities. So here's the formula. We've got total liabilities over total assets times 100. It has implications for both the risk, long-term stability, and return on owner's investment. So there's a link between debt ratio and return on owner's investment, which we're going to look at. So looking at Google's liabilities over the 2 years, we can see it's also increased, total liabilities. Working out the debt ratio over the 2 years following the formula, the first year in 2013, Google's debt ratio is 21.29%, which means 21.29% of Google's total assets are funded by external sources, such as loans. In 2014, both figures have increased. So total liabilities have increased and total assets have increased. Looking at the debt ratio, 20.37% of Google's total assets are funded by external sources. So over the 2 years, the debt ratio has fallen. We've got more liabilities, but we've got an even more greater amount of assets. So what does this mean? It means that the debt ratio has decreased over the years. This is caused by the total assets increasing proportionally greater than total liabilities. Google is using more equity than external sources to fund its assets, overall reducing the risk of not meeting debts as they fall due. So they've got less risk. They've got more assets, more liabilities, but they've got a greater amount of increase in assets, which was funded then by owner's equity, since the accounting equation is assets equals liabilities plus owner's equity. And this actually affects return on owner's investment. So remember before when we looked at return on owner's investment, it had decreased. So looking at the summary, debt ratio and ROI relationship, now we've looked at the Google example, debt ratio has decreased, so they're relying less on liabilities as a percentage, but assets has overall increased. So this extra money they use to get more assets is coming from owner's equity. They were relying more on owner's equity. And as a result, this decreases ROI. When the denominator has increased, the overall number, so if the denominator increases, we've got more capital, the overall ROI would decrease, since net profit didn't increase at a greater rate than the capital increase. And this is the end of the video.